My name is James McFall and our business is Yield Financial Planning. What I'd like to talk about today is investment advice and why being proactive with your investment strategy is so important. Ultimately, investment markets are moving very quickly, daily, by the minute, by the second, and in order for you to invest in a manner that's appropriate for you, it's important to understand a range of things. Understanding what time frame you have to make the investment is a really important one and will dictate how much risk you should be taking with the money. It will be a key part of that decision-making process. At Yield, we have an active investment committee that we operate on a monthly basis. So once a month we meet as an investment committee. We'll thrash out how the investment markets are performing, macroeconomic factors that are influencing markets, as well as investment selection itself. What drives investment return are two critical factors: asset allocation and investment selection. When we're looking at asset allocation, it is the biggest driver of return, and basically we're talking about how you split your money up between cash, fixed interest, Australian shares, international shares and property. That's the highest level. We would define the shares and property as growth assets and the cash and fixed interest as defensive. To give you a good example of how important asset allocation is if you had all of your money in cash through the GFC, you would have greatly outperformed anyone who had exposure to shares. If you'd stayed in cash since then, you would have underperformed people who have share exposure almost certainly. So asset allocation is really important. When you're weighing up what the right split between defensive and growth assets are, one of the really important parts of the puzzle is your own personal risk profile. So taking the time to understand what level of risk you're comfortable with is an essential part of investment management. Certain things that come into play with that are your overall comfort with volatility. You don't want to be in a position where investment markets have fallen, your value's down and you sell it and realise a loss. More often than not, if you've got your assets well diversified, then with time those losses can be recouped, and with growth to go with that. A good example is that even if you had invested at the top of or for our clients that invested at the top of the market in 2007, just before the GFC, it took until 2012 to fully recover the loss. So for what was one of the worst market falls in history, second only to the Great Depression, it took 5 years in that scenario, in that situation, to recuperate the loss and be back into a growth path. And since then, the market's grown strongly. Just drop us an email or give us a call and we'll be happy to start the conversation.